5 ways rich people make money with debt. In finance, there's both bad debt and good debt. Bad debt happens when you owe money for things that lose value and have fixed payments. Good debt is when you borrow to get things that increase in value or make more money than what you owe. Both types of debt have risks, but with some, you earn money, and with others, you have to pay. In this video, we are going to teach the best ways you can use your debt to make you rich. Debt can help you become rich by using other people's money to control assets that grow in value and generate cash flow, boosting your overall wealth. Good debt lets you leverage your resources, so even with a small monthly payment, you can control assets worth much more. Your profits come from the value of the assets you control, not just from your payments. Many businesses start by taking out loans so that the owner can get the money they need to begin and run the business. While the bank gets the interest and payments, the business owner gets ownership of the business itself and the potential for future profits and cash flow. Debt gives people the money they need to create valuable assets. With access to debt and credit, anyone can become an investor. Rich people use debt to increase their returns on their money by taking out low-interest loans to expand their control over assets. With a large credit line, their money and assets can be used as security for loans, which they then invest in other ventures. This means their assets can be making money while the borrowed money is also generating returns, helping to grow their overall wealth faster. Now, let's see what are the 5 powerful ways to use debt to build wealth. Number 5. Leverage investing in real estate. Investing in real estate lets you use a small amount of money to control a much bigger property, thanks to something called leverage. For example, you could buy a $200,000 house with just a $10,000 down payment and a $2,000 monthly payment. This means you're controlling a property worth 20 times your down payment. One of the best things about real estate is that when the property's value goes up, you make money not just on what you put in, but on the whole value of the property. Say the house's value rises 20% to $240,000. Your $10,000 down payment now represents a 300% return because you're making money on the full $240,000 value. Debt can also help you buy properties that bring in rental income. Instead of needing all the money up front, you can borrow to buy properties and make money from the rent they generate. This means you're earning returns not just on what you invested, but on the whole property value. For instance, if you buy multiple rental properties using debt, you can earn much of rental income compared to what you initially invested. Similarly, if you turn properties into Airbnb rentals using debt, you can create a steady stream of cash flow. This way, you're making returns based on the total debt you used, not just your initial investment. Number 4. Short selling. Selling short flips the usual way of buying and then selling stocks on its head. It means selling something you don't own. Here's how it works. You borrow stocks from your broker and sell them to someone else. But remember, you have to return those shares to your broker later. Even though you get cash from the sale, you have to use it to buy back the shares to give back to your broker. So, you're basically holding on to cash, but owe your broker shares. It's like being in debt for those shares, using credit from your margin account. When you decide to buy back the shares you sold short, you're making a purchase to cover your short position. You buy them back from the open market, and then your broker can return those shares to where they were borrowed from. Nowadays, it's all done using computers and automation. Selling short means you're doing things backward, selling first and buying back later. If you sell short for a higher price than what you buy it back for later, you make a profit, even though you're using borrowed money. But while you're waiting for the price to drop, you have to pay interest on the borrowed shares. And if the stock pays out dividends while you're shorting it, you're responsible for paying those too. This is how traders can make money, whether the stock market is going up or down. Number 3. The Buy, Borrow, Die Strategy. Rich people use a clever plan to make more money without paying too much tax. It's called the Buy, Borrow, Die Strategy. Let me explain it simply. First, they buy something valuable, like a house or stocks, that will probably be worth more in the future. Then comes the borrow part. Instead of selling their valuable stuff when they need cash, which would mean paying a lot of tax, they borrow money against it. They use their valuable thing as a guarantee to get a loan from a bank or another lender. This way, they can get the money they need without losing their valuable assets. Then, there's the die step. When the person who owns the valuable stuff dies, their kids or whoever they've chosen get it. But because of certain rules, when the valuable stuff gets passed on, its value is reevaluated. This means any profit made on the asset while the original owner had it doesn't get taxed. So when the heirs sell the stuff after paying off the loan, they don't have to worry about paying a big chunk of their profit in taxes. This BuyBorrowDie plan is like a special roadmap for getting richer while paying less tax. But it's not as easy as it sounds. You have to be smart about what you buy, careful about how much you borrow, and make sure your family knows what to do when you're not around anymore. Plus, you need to follow all the rules to make sure you're doing everything legally and ethically. Number 2. Margin account. A margin account is like a special bank account for trading stocks. In this account, your broker can lend you money or shares based on the stocks you already own. This borrowed money or shares act as collateral, allowing you to buy more stocks than you could with just your own money. When you use the money your broker lends you to buy stocks, it's called margin trading. This boosts your purchasing power, letting you make bigger trades and more of them. It's handy for getting into and out of trades quickly without waiting for transactions to clear. But there's a catch. When you trade on margin, your wins and losses get bigger too. If you trade double the usual amount and you win, your profits are doubled. But if you lose, your losses are also doubled. One best thing about margin accounts is they can double the size of your trades. That's if the stocks you're buying can be fully used as margin. This means you can make bigger moves in the market. For day traders, margin lets them keep on trading without having to wait for all their trades to be finalized. Number 1. The leveraged buyout strategy. A private equity (PE) firm is like a financial superhero that hunts for hidden treasures among private companies. They're experts at finding undervalued businesses with lots of potential. One of their favorite strategies is called a leveraged buyout, LBO. In an LBO, here's what the PE firm does. They search for companies that need a little love, ones they can help grow by fixing things like costs or finding new customers. Once they find a company they like, they use borrowed money to buy it. This lets them make bigger investments than they could with just their own cash. After buying the company, they put its profits towards paying off the debt they used to buy it. This helps them get their money back while still owning the company. Eventually, they sell the company for hopefully more than they bought it for. This is where they make their big bucks. LBOs are exciting because they can make more money than regular investments. That's because they use borrowed money, which means they don't have to put up as much of their own cash. But unlike the previous idea we talked about, which was buying and holding on to something forever, LBOs are more like a quick trip. It's like borrowing money to buy something, fixing it up, and then selling it off again. Sometimes, if things don't work out, they might even have to sell the company or close it down to cut their losses. It's all about making as much money as possible in a short time. That's it for today. I hope you liked this video. If you have any questions or concerns, do let us know in the comments section. Subscribe to our channel for more videos, and I will see you in the next video.